Welcome to the weekly market recap with Securities. Let's take a look at some of the latest developments in the Sri Lankan economy and financial markets. In a move to further ease monetary conditions, the Central Bank of Sri Lanka has reduced its overnight policy rate by 25 basis points, bringing it down to 7.75%. This decision was made during the latest meeting of the Monetary Policy Board after reviewing both domestic and global economic developments. The central bank noted that the rate cut is aimed at guiding inflation towards 5% target, particularly at a time when global uncertainties remain high and local inflation pressures are still subdued. According to the bank, deflationary trends that began to ease in March are continuing as expected. New forecasts show that inflation will likely turn positive in the early third quarter of 2025 and gradually settle near the target range. Core inflation is also expected to rise moderately from current low levels. Inflation expectations are aligning with the target, and the bank sees this as a sign of growing stability. Meanwhile, domestic economic indicators suggest a steady recovery is underway. However, the global outlook has become more uncertain since the previous policy meeting, which could pose challenges ahead. Interest rates in the market have mostly stabilized at lower levels. With the current policy shift, the central bank anticipates further reductions in lending rates. Credit to the private sector remains strong, especially in key industries, and is expected to grow further with support from this latest policy easing. On the external front, Sri Lanka's performance has remained solid this year. Tourism and worker remittances continue to support foreign exchange inflows even as the trade deficit expands. The central bank has also been actively purchasing foreign currency, helping to build official reserves despite ongoing debt repayments. However, the Sri Lankan rupee has seen some depreciation against the US dollar this year, following 2 years of gains. Looking ahead, the Monetary Policy Board says it will closely monitor new data and act as needed to keep inflation stable and support economic potential. Sri Lanka's tea exports recorded a strong performance in April 2025, with total exports reaching 18.2 million kilograms. That's an increase of 1.82 million kilograms compared to April last year, according to a report by Forbes and Walker. The growth was mainly fueled by rising demand for value-added products like tea packets, tea bags, and instant tea. However, bulk tea exports saw a decline, signaling a shift in buyer preferences. The FOB value also climbed. It stood at 1,760 rupees and 31 cents per kilogram in April, up 14 rupees and 86 cents year-on-year. In dollar terms, that's a 7-cent gain, indicating stronger international market performance despite currency changes. From January to April 2025, total tea exports hit 81.41 million kilograms, up by 2.71 million kilograms compared to the same period in 2024. Yet, not all was positive. Bulk tea and green tea categories saw year-on-year declines during the 4-month period. The average FOB value for this period dropped by nearly 29 rupees when measured in local currency. But interestingly, in dollar terms, the value increased by 15 cents. This reflects favorable exchange rates and improving global demand. Analysts pointed out that while high export volumes are promising, the industry must continue focusing on innovation and diversification to stay globally competitive. Looking at major markets, Iraq led the way, importing over 11.5 million kilos of Ceylon tea, a 13% jump year-on-year. Libya followed with a staggering 353% rise, importing 7.61 million kilos. Russia took third place but saw a 9% drop in imports. Meanwhile, exports to the UAE and Turkey also declined by 35% and 19% respectively. Chile, China, Saudi Arabia, and Germany rounded off the top importers during the first 4 months of 2025. Loan demand in Sri Lanka remains strong in the first quarter of 2025 and is expected to rise further in the coming months. That's according to a new survey by the Central Bank of Sri Lanka. The survey reveals that loan demand from small and medium enterprises rose sharply, with the index climbing to 82.2 in the first quarter, up from 65 in the previous quarter. Corporate loan demand is also on the rise. After standing at 57.9 in the final quarter of 2024, it is projected to reach 81.2 in the second quarter of this year. The central bank attributes this growth to several positive developments. These include greater political stability, falling interest rates, stable inflation, and stronger business confidence. Looking ahead, the central bank expects loan demand to increase further in the second quarter. This is driven by anticipated economic growth and the easing of vehicle import restrictions. On the monetary side, Sri Lanka followed a deflationary policy path from late 2022 to mid-2024. However, in the final quarter of 2024, a brief return to money printing triggered reserve losses and a current account deficit. Analysts now caution that excess unsterilized liquidity, especially from dollar purchases, could pressure the rupee if it flows back into the credit system. Meanwhile, non-performing loans have shown a downward trend across most sectors. According to the central bank, improved business conditions, better recovery efforts, and flexible payment options have all contributed to the decline. However, the retail sector remains under pressure. Rising living costs have pushed up bad loans in that segment. Sri Lanka's Purchasing Managers Indices for April show a seasonal slowdown in manufacturing and a moderate expansion in the services sector. According to the Central Bank of Sri Lanka, the manufacturing PMI fell sharply to 40.1 in April. This drop reflects a contraction in key areas like production, new orders, employment, and stock of purchases. The decline was mainly driven by reduced festive season demand, particularly in the food and beverage sector, and fewer working days during the Sinhala and Tamil New Year holidays. Many factories temporarily closed during this period, and manufacturers also scaled back temporary staff after seasonal production needs ceased. Adding to the slowdown, supply chain disruptions during the holidays lengthened supplier delivery times. However, the central bank said the outlook for manufacturing over the next 3 months remained positive, with demand expected to improve. Meanwhile, the services PMI stood at 60.6 in April, signaling continued growth but at a lower pace compared to March. Expansion in the services sector was supported by strong activity in wholesale and retail trade, boosted by festive shopping, and in financial services, driven by increased lending. Still, extended holidays and global uncertainty, particularly over US import tariffs, did limit activity in some areas like freight forwarding. New business activities and employment continued to rise, while backlogs of work declined. Looking ahead, the central bank noted stronger business activity expectations for the next 3 months, supported by the temporary suspension of US import tariffs. Let's take a look at this week's Treasury-bill auction results. With the recent Treasury-bill auction, the 91-day T-bill rate stands at 7.65%, showing no change compared to previous week. The 182-day T-bill rate stands at 7.98%, down by 1 basis points, and the 1-year T-bill rate stands at 8.30, showing down by 1 basis points compared to the previous week. Thank you for watching. We'll be back next week.